On January 27th, a quiet shift occurred inside the silver market, without headlines, warnings, or public explanations from banks or regulators. No emergency statements were issued, no analysts discussed it on television, and no price spike appeared on trading screens. But inside the system, large financial institutions made a move they had resisted for more than a decade. They stopped betting against silver entirely, closing positions that had quietly controlled the market for years. For over a decade, these short positions acted like an invisible ceiling, absorbing rallies before prices could escape. That ceiling has now been removed, and when institutions remove pressure, it is never random or emotional. This was not retail speculation, not panic buying, and not a reaction to news cycles or social media narratives. It was a coordinated, silent repositioning by entities that move only when the math no longer favors delay. This repositioning did not happen in a single day, but January 27 is when its implications became impossible to ignore. Publicly, silver prices still look calm, almost boring, giving the impression that nothing meaningful was happening. But price is often the last thing to react when control inside a market quietly changes hands. What matters first is positioning, not headlines, and that positioning had already flipped. For years, banks benefited from silver staying suppressed, allowing them to manage risk and extract steady profits. A rising silver price would have worked against those positions, which is why rallies rarely survived for long. Every time momentum built, selling pressure appeared, cooling the market before it could attract attention. That pattern created a sense of stability, but it was an artificial stability maintained through positioning. Now that pressure is gone and the absence of resistance changes the market's behavior entirely. Markets behave differently when sellers step away, even if buyers do nothing new. The danger for most observers is assuming that calm prices mean nothing has changed. Historically, the most violent moves begin after long periods of visible inactivity. By the time volatility appears on screens, the internal shift is already complete. This is why institutional money moves before retail narratives form. Banks do not wait for confirmation, they move when probabilities quietly tilt in their favor. On January 27th, that tilt was no longer theoretical, it was embedded in the structure of the silver market itself. This shift becomes clearer once you look at who was involved, starting with banks like J.P. Morgan that shaped silver for years. For more than a decade, J.P. Morgan carried one of the largest short positions in the silver market, quietly influencing price behavior. Those positions allowed silver to stay muted, even as inflation rose and industrial demand expanded globally. While silver traded near $18, then $22, and later $26, banks continued to lean against any sustained breakout. This kept silver psychologically uninteresting, especially compared to gold trading above $2,000 per ounce. But behind that calm pricing, physical silver was steadily moving into private vaults and bank-controlled storage. By 2024, estimates showed J.P. Morgan holding hundreds of millions of ounces of physical silver outright. At the same time, paper markets like COMEX continued trading massive volumes disconnected from physical supply. COMEX prices showed stability, but registered inventories quietly declined toward historically low levels. By late 2025, registered silver on COMEX hovered near 30 million ounces, an extremely thin buffer. That meant dozens of paper claims existed for every single ounce available for delivery. In this environment, holding a large short position became increasingly dangerous for any major bank. A small surge in physical demand could force delivery stress, exposing paper positions instantly. This is the risk large banks avoid at all costs because it threatens systemic credibility. So instead of waiting for stress to surface publicly, institutions moved first and closed shorts quietly. By January 27th, multiple data points confirmed that major banks were no longer positioned against silver. This included a sharp reduction in reported short exposure from institutions historically tied to suppression. At the same time, physical premiums in places like Dubai and Shanghai moved far above screen prices. In some markets, physical silver traded above $140 while COMEX prices lagged near $25 to $30. That divergence signaled something deeper than speculation, pointing to structural imbalance. And structural imbalances are exactly what institutional money responds to before headlines appear. What made this shift far more serious was how quietly it unfolded, without press releases, analyst notes, or public explanations. Major banks did not announce a bullish stance on silver or explain why their exposure suddenly changed. Instead, the evidence surfaced indirectly through positioning data, vault movements, and delivery behavior. In late December and early January, unusually large silver deliveries began moving through J.P. Morgan-controlled vaults. On several COMEX delivery days, J.P. Morgan accounted for the majority of physical silver delivered to counterparties. This behavior stands in sharp contrast to prior years when the bank benefited from keeping metal off the market. Delivering physical silver reduces available inventory and increases pressure on already thin registered supplies. Yet deliveries continued, suggesting confidence rather than concern about future availability. At the same time, reported short exposure from large banks declined sharply compared to historical norms. Positions that once absorbed silver rallies no longer appeared in the same size or structure. This shift coincided with rising lease rates for physical silver toward the end of 2025. Lease rates briefly moved into double-digit territory, signaling difficulty sourcing metal even short-term. When banks pay elevated rates to borrow silver, it reflects scarcity, not surplus or comfort. Scarcity forces institutions to reassess risk faster than any macroeconomic forecast. Short positions only work when supply is easy to access and confidence in delivery remains intact. By January 27th, both assumptions were weakening simultaneously across multiple markets. This is typically the point where institutions step aside rather than attempt to enforce control. Not because prices are already high, but because future outcomes become asymmetric. Silver did not need to rally for this shift to matter. Positioning alone changed the structure. Without heavy institutional selling, even moderate buying pressure can trigger outsized reactions. This is how markets move violently after long periods of visible calm. By the time volatility appears on price charts, the internal shift is already complete. Silver quietly entered that phase as January came to a close. The deeper issue is that silver is not just another traded commodity, but a market built on confidence in delivery. Paper contracts only function when participants trust that metal exists somewhere behind the promises. For most of the past decade, that trust remained intact because few ever asked for physical delivery. Traders rolled contracts forward, settled in cash, and allowed the system to function without friction. But that behavior has started to change quietly, without panic or headlines drawing attention. More participants are now requesting delivery instead of rolling paper contracts into future months. This shift increases stress on vault inventories that were never designed to meet broad physical demand. COMEX registered silver, the metal actually available for delivery, has fallen toward critical thresholds. By late January, registered inventories hovered near 30 million ounces, an extremely thin margin. Against that supply, hundreds of millions of paper ounces continue trading daily without interruption. This imbalance works only as long as confidence remains unchallenged and withdrawals stay limited. Once that confidence weakens, the structure becomes unstable very quickly. Banks understand this dynamic better than anyone because they operate inside the system itself. They see delivery data, lease rates, and vault movements long before the public notices changes. When those signals align, institutions adjust positioning before stress becomes visible. That adjustment is what occurred quietly leading into January 27th. Banks did not wait for prices to rise or media narratives to form. They responded to tightening conditions inside the physical market itself. This is how institutional money moves when risk shifts from theoretical to structural. Price is always the last variable to react when control inside a market begins to slip. Silver now sits in that vulnerable transition phase between calm and revaluation. What made late January critical was not a visible price move, but the disappearance of resistance that had defined silver trading for years. For over a decade, institutional selling pressure consistently capped silver rallies, preventing momentum from attracting broader attention. That pressure created a false sense of stability, even as inflation rose and industrial demand for silver expanded globally. When this selling pressure fades, markets rarely react immediately, but their internal structure becomes fragile. Fragile markets often appear calm right before major moves because control has already shifted behind the scenes. Large banks understand this dynamic and exit positions before prices begin reflecting new structural realities. Silver prices remained quiet on screens, reinforcing the belief that nothing meaningful had changed in the market. But structural shifts do not announce themselves through price alone, especially in markets built on paper contracts. Instead, these shifts appear through positioning data, delivery behavior, and access to physical metal. By the end of January, all three indicators began aligning in a way banks could not ignore. Physical silver became harder to source even as paper trading volumes stayed elevated across exchanges. This widening disconnect increased risk for institutions relying on contracts rather than secured physical supply. Banks responded by reducing exposure to positions that depended on abundant and flexible metal availability. This was not a short-term bullish bet, but a strategic decision to stop fighting tightening supply mechanics. Institutions rarely attempt to enforce price discipline once underlying delivery dynamics turn against them. At that point, preserving optionality matters more than maintaining artificial control over market behavior. Silver quietly crossed that threshold as January progressed without drawing public attention. Most participants remained focused on charts and headlines, missing changes occurring inside the system itself. Markets are driven by mechanics long before narratives form, which is why reactions often appear sudden. By the time attention returns, positioning has already determined how violently prices can respond. Silver entered that vulnerable transition phase as January 27th passed without acknowledgement. What happens next depends less on speculation and more on whether physical supply can meet rising demand. That question now sits at the core of the silver market, regardless of whether most people see it yet. The pressure on silver did not come from banks alone because global supply dynamics were already tightening quietly. One of the most important shifts occurred outside Western markets, far from COMEX screens and U.S. headlines. On January 1st, China implemented new export controls on silver, classifying it as a strategically sensitive material. Silver was placed under the same regulatory framework as rare earth elements and critical industrial resources. Only a limited number of Chinese companies were authorized to export silver, each requiring direct government approval. This matters because China refines between 65 and 70% of all silver produced globally. For years, China exported thousands of tons annually, acting as a release valve for global supply pressure. Those exports are now restricted, meaning far less silver reaches international markets from the largest processor. China's decision was not symbolic but defensive, aimed at securing material for domestic industrial demand. Solar manufacturing, electric vehicles, electronics, and infrastructure all depend heavily on silver inputs. China dominates each of those industries and cannot afford supply disruptions during expansion cycles. By restricting exports, China effectively tightened global supply without changing mine production numbers. This created pressure that paper markets cannot resolve through contracts or settlement mechanisms. Western markets rely on assumptions of global flow and availability that no longer fully apply. When physical metal stops moving freely, price signals become delayed and distorted. Banks recognized this shift long before it appeared in mainstream coverage or analyst commentary. A market squeezed from both institutional repositioning and supply restriction behaves differently than expected. This is where silver moved as January progressed, even while prices appeared deceptively calm. What changed next put silver under pressure from a completely different direction, one that price charts could not reflect yet. While banks were flipping positioning, physical silver supply was tightening outside Western financial markets. On January 1st, China quietly introduced new export controls that directly affected global silver availability. Silver was officially classified alongside rare earths as a strategic material requiring government approval to export. Only a small group of Chinese firms can now ship silver abroad, and each shipment requires state authorization. This matters because China refines nearly 70% of the world's silver before it reaches end markets. For years, China exported more than 4,000 tons of refined silver annually into global supply chains. Those exports helped stabilize prices even when demand from electronics and solar manufacturing surged. Now that flow is restricted, meaning less physical silver reaches markets like Europe, Japan, and the United States. Paper prices on COMEX still show silver near current levels, but physical buyers are already paying more. In markets like Shanghai and Dubai, physical silver trades far above paper quotes, reflecting real scarcity. This gap between paper silver and physical silver is where pressure begins building inside the system. When supply tightens while demand remains steady, price does not move immediately, but stress accumulates. That stress eventually forces revaluation, often suddenly, when inventory buffers are exhausted. Banks understand the sequence well, which is why positioning shifted before supply headlines appeared. As January 27th passed, silver sat at the center of a system adjusting faster than prices suggested. This is why silver prices on screens look calm while physical markets signal something very different underneath. On COMEX, silver still trades near familiar levels, creating the illusion that supply remains comfortable. But when buyers try to source real silver bars, premiums quickly expose how tight the market actually is. In parts of Asia and the Middle East, physical silver already trades dozens of dollars above paper prices. That gap is not speculation, but a warning that inventory is no longer moving freely through the system. Historically, when physical silver detaches from paper pricing, revaluation does not happen gradually. It happens after inventories reach a point where delivery obligations can no longer be met smoothly. At that stage, price becomes a tool to ration demand, not a reflection of balanced trading. Banks know this dynamic well, which is why they avoid being short when physical supply tightens. A short position works only when metal can be sourced easily at predictable costs. Once sourcing becomes uncertain, the risk profile changes completely for large institutions. Silver does not need to explode higher immediately for this shift to matter. The danger is that once the move starts, price can overshoot before new equilibrium forms. As January moved forward, silver sat in that unstable zone between visible calm and hidden pressure. What happens next depends on whether supply loosens or demand forces the issue first. Either way, silver is no longer behaving like a market fully under institutional control. As inventories tighten, silver becomes less about speculation and more about access to physical supply. When access matters more than price, markets stop behaving in linear or predictable ways. This is where silver historically transitions from ignored to uncontrollable within short time frames. Price can stay quiet longer than logic suggests, but only while inventories absorb pressure. Once that buffer's gone, adjustment happens fast, often catching most participants off guard. Banks exiting short positions before this phase signals they expect instability, not smooth repricing. Silver does not need a catalyst when structural pressure already exists beneath the surface. Catalysts only accelerate moves that systems are already preparing for internally. As January progressed, silver sat at the center of tightening supply and cautious institutional behavior. That combination rarely resolves sideways for long once attention begins returning to the market. By the end of Part 2, silver is no longer just a metal, but a pressure point inside the system. What comes next depends on demand, inventories, and who still believes paper represents reality. What most people still miss is that silver is no longer driven mainly by investors, but by industrial necessity. Unlike gold, silver is consumed, embedded into products, and removed from circulation permanently. Every solar panel requires silver for conductivity, and there is no viable substitute at scale. By 2030, solar alone is projected to consume thousands of tons of silver annually. Electric vehicles use significantly more silver than combustion cars, and global EV production keeps accelerating. At the same time, data centers powering artificial intelligence require massive amounts of silver in wiring and hardware. Companies like Tesla, Apple, Microsoft, and Amazon all depend on silver to scale future technologies. This demand did not exist at today's level even 5 years ago, but it is now expanding rapidly. The problem is supply cannot respond quickly because most silver is mined as a byproduct of other metals. Even if silver prices rise sharply, miners cannot instantly increase output without new copper or zinc projects. New mines take 7 to 10 years to develop, meaning supply remains constrained through the decade. That creates a situation where rising demand collides with slow, inflexible production. Historically, when this happens, price becomes the mechanism that forces rationing. This is why silver bull markets tend to be sharp, volatile, and difficult to control. Banks see this coming, which is why they exited positions before the pressure becomes visible. As January closed, silver sat between accelerating demand and a supply system that cannot adjust. That imbalance does not resolve quietly once attention returns. What ultimately matters is not where silver trades today, but how quietly control over it has already shifted. Markets rarely break when everyone is watching. They break after pressure builds while attention is elsewhere. Silver moved through that phase quietly, without panic, headlines, or public warnings from institutions. Banks reduced exposure, supply tightened, and industrial demand kept rising without waiting for permission. None of these forces act alone, but together they change how a market behaves under stress. When access becomes more important than price, systems stop rewarding paper confidence. This is when official prices begin lagging reality instead of reflecting it. History shows that markets tied to real inputs do not resolve imbalance smoothly. They adjust suddenly once inventories, trust, or control reach their limits. Silver now sits inside that kind of system, shaped by necessity rather than speculation. The shift did not start with retail interest, and it will not end with it. It started with institutions quietly stepping aside and supply quietly tightening. What follows is not driven by belief, but by math, access, and physical constraints. Those forces move regardless of narratives, forecasts, or comfort levels. That is what makes this moment easy to miss and hard to reverse. And that is why silver no longer behaves like it used to, even if it still looks that way on screens.